So today we're going to talk about a very interesting topic, credit scores. You probably don't think that's interesting, but you know what would make it more interesting? If you could improve your credit score by using the infinite banking concept. If we bring those two things together, this is an interesting topic. And also a very timely one, because right now, credit card debt in this country is at an all-time high. But it's not just credit card debt, it's car loan debt, it's student loan debt, it's all debts in this country. And credit scores play a major factor in whether or not you can get a car, whether or not you can get a loan, you can buy a house. It's all hinged on this one little thing that very few people understand, your credit score. So let's talk about how to improve that, but not just that. Let's talk about how to improve it without going into debt. Hey, we have a huge debt problem in this country. And I'm not just talking about the United States of America and their deficit. I'm talking about Americans in general. They are in debt more than they've ever been in history. Check this article out right here. Motley Fool nailed it. They're talking about consumer debt, and there are types that are not included in here. 17.796, hold on a second, trillion. With a T. It's kind of like that thing in Austin Powers. Trillion. Yes, you remember that. $17 trillion. The average household debt in 2023, and it has gone up since then, is $104,000. Holy crap. Total mortgage debt, $12.519 trillion. Total revolving home equity line of credit debt, $380 billion. Total auto loan debt, a whopping $1.6 trillion. And total credit card debt is now over $1 trillion. There's the numbers. How is this even possible? Well, we like nice things, right? We want fancy cars, we want nice houses, we want to go out and live the American dream, but that comes with a cost. What is the cost? According to this, about 9.8% of your income. The first law of wealth is 10% of your income should be kept. So what do I mean by that? Savings, silly. Yes, you should be saving 10%, not paying 9.8%. Let's just round that up to 10. I mean, oh, come on now. That's what you're paying on your debt. That's what Americans pay on debt, which is why we have a major saving problem here in the United States of America. But I got some good news. What if I could show you how to build wealth, your wealth, how to build lots of wealth, by doing nothing other than using your debts and expenses? That's right. What if we could build wealth through your debts and expenses? You're already spending the money. I mean, right here, 9.8%. I think if I went to 2024, we're definitely over 10%. So if the first law of wealth is keep 10%, well, let's talk about the easy way to do that. Let's just make all your debt payments, that 10% of your income, savings. It's kind of like how banks do it, right? Banks take your deposits in, and on the books they call that a liability. Why? Because they owe it to you. But they flip it around, they lend it out, and now it's an asset. They're turning liabilities into assets, and you can do the same exact thing. The infinite banking concept is the path, and the infinite banking concept is you taking back the banking functions in your life. In other words, you take back those debt payments, that 10% or 9.8 in 2023. Just take it back. Now, hold on. Let me pump the brakes because you're like, Chris, have you seriously smoked something really good? Not at all. I don't do any of that stuff. I just know something you don't know. And that's what we're going to get into. But before we dive into credit scores, I got to ask something. Right now, I got to ask you to click that thing right there. Yep, that little subscribe button. And then while you're at it, there's a little bell up top. I need you to take the bell, smash it, and you know what? Just like Josh Allen yesterday,
he's got his man, and a juggling catch by Ray.
But let's just think about credit scores. I mean, there's got to be a lot of factors in credit scores, like age, demographics, where you live. I mean, all those things, right? Nope. Check this report out right here from Experian. Gen Z's credit scores are 680. Millennials are 690. Gen X's, my generation, we're peaking the 709, so we got a little edge up on those Gen Zers and millennials. But then when we get to the baby boomers, they're rocking 745s out there. In the silent generation, grandmas and grandpas, man, they're rolling in at 760s. They're crushing it. So what does that tell you? it tells you that they know something that the younger folks don't. No, I'm just kidding. It just tells you that they've learned how to pay off their debt. They went through one of those Dave Ramsey programs and put money in an envelope and bought term and invested it. I'm totally kidding. That's not what they did. But they definitely figured out how to improve their credit score. But it's okay that the younger folks have lower credit scores because they're utilizing more debt. But here's an interesting fact right here from American Express. Check this stat out. Take a look at this. This I found really interesting and not what I was expecting. When we look at credit scores, they've been going up. Like throughout time, at least the last decade, credit scores have gone up, but yet we've utilized more credit. And we're gonna get into why, but before, does that surprise you? Like if we're utilizing more debt and defaults and delinquencies are going up, like how is it that credit scores are higher? Well, this might be a little bit of an education thing because look right here. If we look at what makes up the scoring profile for your FICO, so take a look right here, 35% of your FICO is made up of payment history. Then 30% is the amount you owe. This has always been a big thing. If you're rolling it right at red line, kind of like your car, if you're redlining your car, eventually the motor's going to blow. So if you're redlining your credit and you're utilizing all of it, well, that's hurting your score. 30% accounted for there. 15% is the length of your credit history. So remember I was saying that the older folks, like the silent generation and the baby boomers, had higher credit? They just had more time. So that makes perfect sense if that's 15%. 10% is the credit mix. So what type of credit are you using? So an 18-year-old might only have a credit card, where a 40-year-old might have a car loan, a mortgage, a personal loan, and several credit cards. Follow what I'm saying there? And then 10% is new credit. Those new credit applications you're submitting, every time they pull your credit, that accounts for 10%. So now that you can see that that's what's going on and what makes up your FICO, you still gotta ask, why is it that credit scores are going up? So if any of you are like me and you're thinking to yourself, how can FICO scores be going up nationwide? Well, I think they figured it out. Who figured it out? Well, FICO figured it out. You remember that little thing called COVID? Yeah, I know, I'm glad you forgot about it because I kind of did too, but the pandemic, you remember when they shut everything down, everybody had to go home, sit in their room, not come out, otherwise you got your hand slapped, especially here in New York. You Floridians, don't even comment because you guys, like, nothing even happened down there, right? But for the rest of us, like, it was kind of rough. And when we were all sitting there, what could we not do? Well, we couldn't go out to restaurants, we couldn't go to the movies, we couldn't go shopping, we didn't have to drive our cars. Yeah, we really didn't do much of anything except for sit down, veg out on YouTube, veg out on social media, and watch some Netflix. And some of you were doing that Netflix and chill thing, maybe. With masks on, I'm hoping, right? Funny thought right there I just had. But what happened during that time? The government gave you some checks, didn't they? Yeah, everybody got issued a check out of that $5.2 trillion they printed. If you owned a business, you got the PPP and the EDIL. So a bunch of money was flowing into households, but yet no money was really flowing out. Oh, and also, a lot of the debts that you were used to paying, didn't they get frozen? Like you didn't have to make those student loan payments and all those other things. They sort of just froze that stuff. So you had a lot more discretionary income. So what did Americans do? They started paying off debt at alarming rates. Not alarming, but super cool. But they called it at alarming rates. Debts were being paid off. And what was going up? Savings. It was crazy. Debts were going down, savings were going up. And because of that, FICO scores went up. Folks, that was only about, 4 years ago, but really like 2 years ago because it was a longer period of time. So why did credit scores continuously go up? That's why. We haven't even seen the impact of these increased debt loads. We haven't seen the impact of the delinquency increases. We haven't seen the impact of the defaults that are on the rise. We are still living in the pandemic moment where people were saving more and paying their debts off because that's what the credit scores are showing. And that's what these statistics are showing. Oh, but wait, some of you are thinking, Chris, that makes no sense because it's trending up. Yeah, you were paying attention to the slide that I just showed in that FICO report, right? You're right, it is trending up. But you know why? This is a super simple one. All of us are employed. unemployment numbers are way down. So even though debts are up, people have a job, which means they have the disposable income to make the minimum payments, which if you remember what made up your FICO score, until you lose your job, you're gonna make your payments. Until Americans lose their jobs, which also could happen because if the economy slips, the first thing that happens is people get laid off. We're already starting to see that on the move up. Don't believe the job reports, or at least the prior job reports. I think in the future, we might actually be able to believe some of these reports coming out. So, how do we improve your situation? How do we make this all better for you? Well, it's super easy. So first and foremost, let's just go over some basic fundamentals. And I wrote these down because I didn't want to get them wrong, and they're pretty simple. Here's some advice for healthy credit. Pay your bills on time. Duh. Keep your credit usage low. If you got credit cards, don't use up to the max. Like try to use like 30% of your credit card. And if you are using your 30%, you need more, go get another credit card. Because you got a job, you got good credit, go get another credit card and use that one up to 30. I know that's a little trick. Avoid opening too many new accounts. So be careful with that because that's kind of negating what I just told you to do. Maintain a long credit history. Keep older accounts open. A lot of people, when they pay off a credit card, they just want to close the credit card. They want to close the loan. Keep it open. Don't use it, or maybe every once in a while, use it a little bit and then pay it right off. That's how you trick them, and that's how you get those cool little things called points. So keep those open, and also monitor your credit. Most banks will have some type of credit monitoring. You don't even need to pay for it. It's just when you open a bank account, they give you that. So make sure you pay attention to what your credit score is doing. If it's slipping, start figuring out why is it slipping, and they normally will tell you. But let's talk about something way more fun. Now, I'm not going to get super deep into this for the sake of time, but remember I said you could build wealth through your own debts and expenses. I want you to remember back to that one stat about 9.8% of your income is going to debt payments. What would your life be like if 9.8% of your income went to your savings? Well, it would be totally different. So to think about that, what I want you to do is grab a piece of paper and a pen, or maybe you got a good memory. I want you to go through and I want you to add up all your debt payments. Your car loan payments or lease payments. I want you to add up all your credit card payments. I want you to add up all your line of credit payments. I want you to add up your mortgage payment. Add all that up. How much is it? 2 grand? 3 grand? 5 grand? 10 grand? Are some of you rolling in with a $20,000 debt expense every month? I bet there are. Think about that. That should be your savings. If banks turn liabilities into assets, so can you by changing just one thing, and that is where your current savings goes first. Now, this is where the bad news comes in, because what I'm going to tell you next won't work if you're living paycheck to paycheck. If you're not saving any money, I'm sorry, this is where this video is going to get really boring for you. But for most of you that are saving money, maybe you're saving into a 401k, you're putting in above and beyond the match. Let's talk about that. Maybe you're putting money in a brokerage account. Maybe you're putting money in a Bitcoin account. Maybe you're putting money just in a savings account for a rainy day or an emergency. Let's just change one thing. Let's add up how much all those savings are and change where they go first. Not where they go permanently, not where they go for a period of time, just where they go first. We're going to put it into a different account, and then we're going to take it out and we're going to use it in a different way. So if we just did that, how much could you save? Could you do at least 10 times your age monthly? So I know, I don't want you to do the math. I'll just tell you how easy it is. Put a 0 after your age. I'm 47. I'm 47, soon to be 48. When you get older, you'll start forgetting your age. I literally just had that moment. Whew. I'm like, wait a second, am I 48 or 47? Anyway, edit that out. But I'm 47, add a 0 to that, that's 470. That would be the minimum amount monthly for what I'm telling you. So if it's more than that, awesome. Change where it goes first. We're gonna put that into a specially designed whole life insurance policy from a mutually owned insurance company that pays dividends. Now, I know that's not what you were expecting me to say, but I'm telling you, that's what we need to do because we want to earn uninterrupted compounding interest on all that savings. But we're not going to leave it there. You see, we're going to put it over there, then we're going to immediately take a loan from the policy, which means if it's the right company, and just have us design it for you folks, because this is what we do and we are extremely good at this, and we know what companies to use. If you have the money going into this policy and you take a loan from the policy, the insurance company is just giving you money from their general account, and they're doing a little entry in the books where they're just taking it from your death benefit because, I don't want anyone of you thinking you're dying, okay? So we don't need the death benefit today, but it'll be nice someday to have that for our family. So why not just use some of that death benefit while we're living? Now, let me give a little preface, because some people love to just think they can use all the death benefit. You cannot. You can use the amount of your death benefit up to your cash value. So if you put in 10 grand, your cash value is probably $9,000 in the first year. That's the amount you can use, 8 or 9,000, because the insurance companies aren't dumb. They're gonna let you use their money in their general account, but they're gonna collateralize that loan they give you with your cash value. But this is where it gets really cool. When you take the loan out of the policy, all of your money, your cash value, is still earning interest and dividends like it was never touched, because it's just collateralizing that. Think of that like your house. If you have a house and you have a home equity line of credit, you can use money and take it from your equity, but the equity doesn't change, right? It's still the same. You're just using it as collateral. This is no different. You're using your cash value, the insurance company's using your cash value as collateral to give you a loan. And they give you a loan at most company, I'm not gonna say all, but most, at a lower interest rate than what you're earning in guaranteed interest in dividends on that specially designed whole life. So what's next? We're gonna take that. Now, folks, I'm gonna show you there's a little circle here. We changed where the money went first, put it into the policy. Now we're gonna take loans from the policy and we're gonna come over here and we're going to pay off debts in a specific order. I always like to say lowest balance to highest balance. So we're gonna start with the lowest credit card. We're gonna pay those credit cards off, but now we're gonna add something else. We changed where the money went, now we need to add a step. The amount you were giving to those credit card payments or whatever debt payments you just paid off, we're not gonna stop making those payments. I know you wanted to, but remember, I told you I was gonna show you how to turn debts into savings, liabilities into assets. So in order to do that, we gotta take the money you were giving to the credit card and we gotta take it and move it around the bottom part of the circle and put it back into the policy, which means now that money you're putting back into the policy is forced savings. But it's also paying the loan down to the insurance company because the insurance company is charging you simple interest on the loan that they gave you at a lower interest rate than the compounding interest and dividends that you're earning. But now you're recapturing the money you were given the credit card. What was the interest on the credit card? 10, 15, 20%? So that's just like you're paying yourself back 10, 15, 20% interest because you were giving it away. And then we just rinse and repeat. We just keep doing this around and around and around. Every time there's money in the policy, we take it out, we pay off a debt, we take the money from the debt, we put it back in the policy, which now on top of your savings, because there's three components, there's the savings you changed where it was going, that stays the same. Then there is the recaptured money that you were giving away. So savings plus recaptured money, your liabilities being turned into assets, plus all the interest and dividends you're earning, the compounding effect. You are literally going to turn your liabilities into assets. You are going to build wealth through your own debts and expenses. And at the end of this video, I'll give you another video showing you exactly how to do that. So to kind of spin this whole thing that we started with credit, we now are talking about building wealth. This is the perfect way to do it. Because now that you are doing what I just told you, you won't need the banks anymore. You'll create your own private banking system. You will have taken back control of your money because you're no longer gonna need the traditional banks. You're no longer gonna need the credit cards. Now, you're still gonna use credit cards because in today's world, it just makes sense to pay for things with credit cards because you get points and airline points and all that good stuff. But we're gonna have a method to make sure that they always get paid off every single month and you never carry a balance, except for during the month. But you see, if you pay it off every month, you don't pay any interest to them, right? So the only expense we're gonna have with the credit cards is if you use Amex or other cards that have a fee per year, that's it. You literally just took back the banking functions in your life, and that is exactly what I told you the infinite banking concepts does. That process, that circle I showed you, changing where the money went first, utilizing that money differently, and then adding one step, which is the recycle recapture of money you were giving away, is what you need to do. Not only did you pay off all your debts using that process, but you also built yourself a nice little emergency fund. So literally now you got some money sitting over here in the policy that could be used for an emergency. If you lose your job, maybe you got enough cash value to support 6 months of your expenses. Maybe you don't even need to worry about 6 months of expenses anymore because your expenses are only your household living expenses because you have no more debt payments anymore. All of those are now savings components. You see, this solves many problems. And when you're not utilizing any debt and you're not utilizing any loans or revolving credit outside of the credit card little game that we're gonna play, your credit score goes up. Do you see how this works? When you become your own bank, your credit score goes up, your savings goes up, your debt goes down, and you don't have to work harder, longer, or take on any risk to do any of this. Folks, I hope you've enjoyed this. Now, I know there's a lot of questions. Put the questions down below, like this. Check this video out right here, how to get rich with your own debts. Thanks for joining me. My name's Chris Naugle, and this is another episode of BYOB. That is, Be Your Own Bank.